How do you trade market gaps? Should you jump in when the market opens at a gap up or a gap down? Should you wait for the markets to consolidate? So, in this video, I'm going to talk about different strategies, different ways psychologically and technically to look at market gaps and how we can trade profitably from these gap movements. So watch till the end because I'll be discussing a couple of different scenarios that occur a lot in the market. So, when the market opens, I'll be talking about a gap up first. So let's have a look at the charts of Reliance, 5-minute charts. You can use whatever time frame you are comfortable with. So I like shorter time frames because I want to stay in the trade for a short time. So Reliance, this is the chart on the 8th of May, just a couple of days back. So market on the 7th closed at 1512 and on 9:15 at 8th of May it opened at 1538. So that was a very good gap up. So a lot of times what people are doing is that the traders they want to jump in immediately when the market gaps up. So they already know Reliance has a very good news, about the different deals that's happening, the rights issue, all of these issues, and they want to jump in the gap and just to realize that the price falls down and they have to exit at their stop. So, what am I suggesting? Whenever a common gap occurs, we should never hop in when the market gaps up, but we should always wait for the market to find an area of value. So in my last couple of videos, I've been stressing on the support, resistance, price action trading, area of value. So if you haven't seen these videos, do check them out. So what essentially am I saying? So if you see this example, market gaps up to 1546, and people who started buying at this level because market gapped up, they would essentially be in a loss because market came down till around 11 o'clock. It was trading below 1546 at around 1540, so they would probably exit the trade at a stop. So what do? I basically like to wait for the markets to consolidate and come to an area of value. So if you see in this example, we had when the market opened, the first 5-minute candle went down. We again went back up, tested this level of resistance. So the price opening becomes a resistance for you. And we can confirm it with our candlesticks. We are getting a gravestone doji, bearish engulfing, all of that. And the lowest point somewhat acts as a support. It will be different for your different charts. So I am essentially designing my area of values. So now there are two approaches that you can adopt. So one of them would be you can go long at this point around at the area of value because you already know market's gapping up, so it is going to go up. So you can go long at this point, and this way you can keep a very short stop loss, a tight stop loss, and your target can be the level of resistance. So in this way we can do an easy 1.5 is to 1. The other way that I prefer, I wait for a breakout. And if you look at this example, we broke out at this price. So what you can do is you can go long at the breakout, keep your stop just below the level of support resistance, and the target will depend on how you want to define your levels. So in this way, again, we actually are entering a very risk reward favorable trade. I want to stress just for a minute on the volume aspect of it. So whenever we are doing technicals, always have volume and analyze, because volume is one of the most important principles of Dow theory. Principle number 5, that volume must always confirm the trend. So what am I trying to say? Let's have a look. So when the markets start consolidating, my volume started decreasing. So that meant that, whenever there's a consolidation, we will always expect some kind of movement. And what we are essentially waiting for is a breakout with an increased volume. So whenever my breakout happened, how am I sure that this is not a false break and the price will continue, and should I enter here? We can see an increased volume when the breakout happened. So that's a very good indication that trend is strong and you can buy and scalp this. So just to sum it up, you want to be able to scalp this movement and not enter at this point of time. So always wait for markets to kind of stabilize. Let's have a look at a couple more examples. 12th of May, Reliance charts. So stock opened here. We had a big gap down from 1577 to around 1563. So what do you do in this case? Do you immediately enter and scalp this? I would not suggest that. Though there are a lot of strategies that are also on this point that you can scalp this movement for a couple of minutes or maybe seconds and get out. But for retail investors and people who are just getting started in trading, I will suggest you always wait for an area of value, because whenever the market gaps down, there will be some kind of buying, and whenever the market gaps up, there will be some kind of selling, as I discussed. So whenever market gaps down, we can see price going up, finding a good resistance at the area of value. The buying for the day has been done, and now your selling will start. So don't sell around here. Try to let it cool, the buying pressure cool down, and sell at this point. And if we are selling at this point, what can be your target and stop? So if we sell around here, we can see a lot of candlestick entries, doji, shooting star, etc. And we can see the target can be the level of support, and your stop can be just above the resistance. So that's a very good target. If you want to do the other, if you want to trade the breakout, so you can form your resistance and wait for the candles to break out, and whenever the candles are breaking out, you can see increased volume. So you can easily ride that trend, because it's a short buy call, short selling call, because it is confirmed by your volume, and we can easily ride that trend. If you're shorting over here, keep a stop just over this level or over the resistance. Let's have a look at one more example in Reliance. So another example would be 14th, just 1 2 days back. So whenever market gaps down, as I said, there will be some kind of buying to, and also attempt will be made to fill this common gap up. And whenever this, so we are already sure that we want to sell, because Reliance, a lot of selling pressure is there. It's a big gap down. We want to be on the sell side. So people who started selling in the opening session, they would be in trouble, because the market would go up and hit their stop. So what am I looking at? Price. I will wait for the price to go up, consolidate at my area of value. So this will make sure that the price has reached the top for the day. And now when the gap is filled, your selling will start and price goes down. Again, two strategies. You can sell here for a target of the support, or you can wait for the breakout. Just below the support, you can wait for that breakout, trade that breakout, and in all of these cases, you can really keep a very tight stop loss. And to the contrary, if you're selling at the gap, you really would be hitting your stops very often. And in such a case, you have to keep a very big stop loss, and that's not a risk reward favorable thing for me. So I would be out, immediately. So I just want to have a look at Nifty Bank on the 15-minute charts. Just a couple more examples and a different strategy that I like to adopt in my gaps. One example would be around the 17th. The 17th. So what happened in this case? Price gapped up. So I know market's going to go up. So I'm bullish on Bank Nifty. So what do? I'm not going to buy here, because if I buy here, I'm immediately stopped out. I'll wait for the price to consolidate at my area of value. So the price consolidates for a long period of time at my area of value. So I know that a potential support for my intraday level has been set. And you can see when the price consolidates, when the price is falling down, there is a decrease in the volume, because not a lot of people are selling. And I'm essentially waiting for my candlestick entries. And one point of entry can be that you can go long at this point, around these candlestick entries. We can see dojis, hammers, etc. Target, that the stop will be very small. Target can be your level of resistance that's being formed earlier. And we can see that this increase in price is followed by increase in volume. So that's a good entry. So that's one entry. Or the other way is that you can trade the breakout. You can wait for your resistance to be broken, and you can buy over here, keep a tight stop, and trade that. So there are a couple of examples that I like to do when I am trading my gaps. Another example, if we have to discuss, would be another on the 21st. I think this is April. So market gap down. So in this case, I was bearish on Bank Nifty because market's gapping down. Don't sell immediately. Wait for your area of value. So my price consolidates at this zone. It's not able to go above and try to fill the gap. So it's fine. We have to adjust accordingly. So price makes a resistance, price makes a support, and we are essentially waiting for a breakdown, and we can ride that short selling momentum. So that's exactly how you should be able to frame your trades. So you can have a good stop loss, you can have a good target, and you can actually make advantage of those gaps and not be befooled by them and get stuck and hit your stop. So let me know what you are practicing, what you are trading when the market gaps, and I'll see you in the next video.